In this video presentation, you'll learn about private mortgage insurance, also known as PMI, and how you can save thousands of dollars by eliminating monthly PMI with AmeriFund's Prime Premium PMI program. PMI insures a lender against a loss in the event a foreclosure sale on the mortgage loan does not provide enough proceeds to pay the outstanding balance and fees on the mortgage. A borrower is required to maintain PMI where the borrower's down payment on a purchase is less than 20% of the price, or where the borrower's equity is less than 20% on a refinance. The amount a borrower pays for PMI is called a premium. Premiums for PMI can be paid monthly as part of the borrower's housing payment or can be paid in a single premium at closing. On a 30-year fixed-rate mortgage with 5% down, the borrower must pay monthly PMI payments for a period of 109 months. That's slightly more than 9 years. With 10% down, the borrower must pay monthly PMI payments for 85 months, slightly more than 7 years. This chart shows the typical monthly payment for various transaction amounts with 10% down on a 30-year fixed-rate mortgage. Those payments over more than 7 years really add up. On a $425,000 purchase with 10% down, for example, the cumulative monthly PMI paid after 85 months is more than $10,000. There's an alternative that's much better for most borrowers than paying monthly PMI on a 30-year loan. AmeriFund's Prime Premium PMI eliminates the monthly PMI premiums by permitting the borrower to pay a single premium at closing that is a fraction of the amount paid over time with monthly PMI. This chart shows the total potential cumulative savings with AmeriFund's Prime Premium PMI versus a monthly PMI plan at various transaction amounts. You can pause the video for more time to review the data in the table. That single premium the borrower pays at closing can be funded a variety of ways. The borrower can pay the premium in cash, which increases the total cash required at closing. The borrower can negotiate with the seller to pay the premium. This is commonly called a seller concession. The borrower can accept a slightly higher interest rate to receive a credit paid by the lender to the borrower at closing, sufficient to pay the single premium, and usually sufficient to pay a portion of the other closing costs as well. Or the loan amount can be increased to finance that premium on transactions with 10% down. This example compares the payment and cash required at closing on a transaction with monthly PMI, one with AmeriFund's Prime Premium PMI, and one with a piggyback loan structure with an 80% first lien and a 10% second lien. This example assumes a purchase price of $375,000 with 10% down on a 30-year fixed-rate mortgage. In this example, we have also financed the premium on the Prime Premium PMI option, which increases the base loan amount to $341,995. As you can see, the monthly PMI premium in this transaction increases the total payment to slightly more than $2,700 with estimated cash required at closing of about $38,163. In the right column, we show the piggyback dual loan structure. We increased the interest rate by 1/4 percentage point to compensate for the pricing adjustment on the first lien mortgage for secondary financing. By increasing the rate to 4.5%, we can keep the closing cost to something just above $38,875, only a few $100s more than the bottom line on the transaction with monthly PMI at 4.25%. But even with the higher rate and principal and interest payment on the first lien mortgage, the combined payment at this interest rate is still about $20 lower than the payment with the monthly PMI, since the piggyback eliminates the PMI portion of the payment. Because we increased the loan amount to finance the premium paid at closing on the Prime Premium PMI option in the middle column, the principal and interest payment increases nominally by about $22. But even with that nominally higher principal and interest payment, the Prime Premium PMI option is much superior to the monthly PMI alternative because the $104 per month PMI payment is avoided with the Prime Premium PMI transaction. As you can see, the total payment at just over $2,619 is much lower than either of the other two options, and the amount of cash required at closing is also less. The lower payment with the Prime Premium PMI, combined with the lower cash required at closing, will save the borrower several $1,000s over the first 7 years of the loan. In our example, the savings would be about $4,400. The lower payment with the Prime Premium PMI, combined with the lower cash required at closing, will save the borrower several $1,000s over the first 9 years of the loan. Take the challenge. Call an AmeriFund loan consultant for a free analysis that will show you just how much can be saved with AmeriFund's Prime Premium PMI.